All right, what's going on, everybody? My name is Alex Ivanovich. Welcome back to That Makes Zero Sense, the podcast. You've probably been wondering, or maybe you haven't been wondering at all. Maybe that was a little bit of my ego. I've been away 2 weeks. I took some time off to go see my family, and then I went on a little vacation. We didn't get a whole lot of viewer questions over the period of time that I was gone for. So today we're going to do a little bit of a different episode, and I sort of want to take the show in a slightly different direction. So instead of answering 5 viewer questions every single week, although I love that model and I love seeing the questions that everybody has and I love answering them, that's a great model, don't get me wrong. I want to switch it up a little bit to stay in theme with the show. I've received a bit of feedback from some listeners, from some mentors, and in sticking with the theme of the show, which is That Makes Zero Sense, where we're supposed to talk about things that I find silly in the market or in finance in general, I will continue to answer questions on the podcast, not five per se every single week, maybe one or two that I find very interesting or I feel would illustrate a concept well on the show. And then the rest of the points I'm going to save for silly things that I read in either research or in the tape, stuff that I might usually reserve for the short form content because I know it's a little more salacious or controversial. So we're going to bring some of that content onto the podcast. So enough of the word salad, enough of all that nonsense. Let's dive right into the show for today. We got a couple good things to discuss. So point number one that I want to talk about today. Every now and then you're going to see a Wall Street analyst upgrade a stock, downgrade a stock, move their price target around. And some of these analysts, don't get me wrong, these analysts, they're paid a lot of money. Most of them are good at what they do. But every now and then you'll see something that just makes you think, gosh, like, did he really go and get his MBA, or did he really go to school? Did he really put that note out? What was he thinking when he put that note out? I read one of those notes, I think it was not this week, but just at the end of last week. So I'm actually not going to name the investment bank that put out this research. I don't want to tarnish any relationships that I have. I'm going to leave out the analyst's name and I'm going to leave out the firm. I'm just going to talk about the stock, the price target, and a couple of the details that were mentioned in the report. If you want to go and do your own research and figure out who I'm talking about, by all means, go do so. But I'm not going to bash anyone on this show. So one of the firms that I receive research from took SanDisk. Obviously, everybody knows SanDisk, or if you follow stocks whatsoever, you know they've had this massive run year to date. I don't know the exact percentage. I want to say it's 300 something percent. 320% year to date, I think, is what I read. Now, SanDisk is, an $1,000 stock now. When you're in $1,000 name, you do 10, 20 point moves pretty easily. I mean, if you watch ASML, Amazon, or Google, if you remember before the split, stocks that are that expensive, a 1% move is a large dollar figure on an absolute basis. So last week, SanDisk was 1,020, I want to say, when I read this research come out. And this analyst at that point moves their price target from the original price target of 690 to 1,100. So you've basically just sat on your hands for however many months. He's been overweight the stock for a long time. You sat on your hands. I mean, to his credit, he's been overweight the whole time, and the stock's done nothing but go up in a straight line. So on that portion of the call, he's been right. But to sit on your hands and go, la di da di da, 690 is my price target, and you watch the thing go up and up and up and up and up and up and up, and it's $1,000, and you're saying, shoot, I should probably move that PT. I look a little silly right now. And you move it to basically where the stock is trading. I mean, give or take 50 points. It's so silly. It's so mind numbing. It's like, why do you get paid to do what you do? That, like, nobody's going to look at that research and think, oh my gosh, wow, what a great call on SanDisk. Oh my gosh, that price target raise, geez, what a great raise. Like, yes, he raised it from 690 to 1,100. And for somebody who's never watched SanDisk trade, you're like, wow, 400 points on this stock? No, dude, he just watched the name trade up 400 points and realized he was grossly late and then decides to raise his price target. It's the silliest thing I've seen. Silliest thing I read this week. In the note, I think he raises a lot of his estimates to some of these astronomical numbers. And if that's truly what you believe, I mean, I'm not one to judge anyone. If you truly believe that some of these figures you're using, that average sale prices are going to jump roughly 90% in the first quarter and another 70 to 75% in the second quarter. And then you think, okay, I got to move my earnings per share estimate 65% above where consensus figures are. If you truly believe that is the case, and this stock has got massive growth potential, and there's so much more coming for this stock, why are you tiptoeing around 1100 and just following where you just watched the stock go the last 3 months? Put that price target at 1500, 1700, whatever. If you truly believe that these astronomical figures and you have to go this far above consensus, do something outrageous. Don't just stocks at 1020 and I'm going to put it at 1100. The stock's going to be at 1100 in 3 or 4 ticks. It'll be there by the end of the day. As far as I'm concerned, $1,000 stock just trades that way. It's so dumb. I'm gonna move on before my blood pressure gets to a point where I can't sit on this podcast anymore. All right, so that was the makes zero sense part of the pod. Now let's move on to the part that does make a little bit of sense. JP Morgan today downgrades Meta. Why do they downgrade Meta? Well, Meta reported the quarter last night. Stock sold off. It was down 10% in the pre-open session, and I want to say it was down as much as 12 or 13%, maybe even more. The analyst highlights some of the bright spots in the quarter, and I have to admit there were plenty of them in that quarter. But the thing that I love JP Morgan for pointing out, and the reason for the whole downgrade, and why I think it was sort of an intelligent downgrade, because it goes against the consensus of what everyone believes as it relates to AI. Everyone's sort of like, more capex is better, more spending is better, and nobody's really paying attention to the free cash flow degradation and thinking, wow, that's actually a net negative when you see that much free cash flow being burned, essentially. JP Morgan is sort of holding that to the light and holding Meta accountable by saying, hey, we're downgrading this name because we think the capex has just gotten out of control. They've got huge infrastructure costs. There's also limited transparency around the AI roadmap. I don't think they have a lot of users on the app product that they've created. And the competition is really heating up. I mean, look at the quarters out of Amazon and Google that were reported this morning, who are actually knocking it out of the park on some of these initiatives. Meta was the first case, I think, of a hyperscaler being punished because they're scaling the capex to a level that's unsustainable. I mean, I would argue that the level of capex across all hyperscalers has been unsustainable for the past 4 to 8 quarters. But the revenue for Meta is just not showing up. This capex is not translating to meaningful top line growth. Don't get me wrong, there is growth on the top line for Meta, but not enough for investors to say, hey, we're okay with you spending all this cash. And so I think that's a smart downgrade. I love that downgrade. I love anyone who's going to stand in the fire and say, hey, I don't agree with you spending money on something when you don't really have a plan and the AI roadmap is sort of wonky. You just can't reward that when the competition is as fierce as it is with Amazon, with Google, with Anthropic, with OpenAI, with various other players. Okay, that's enough on JP Morgan and the Meta downgrade. Love that call. Let's talk about oil. Somebody on the last episode asked or mentioned, with the war in Iran largely behind us. And I said on that episode that couldn't be further from the truth. And yes, there have not been any bullets flying, no bombs dropped in the area. It seems that Israel is calmed down over there. Lebanon is sort of calmed down. The US hasn't done a whole lot other than place a blockade on the Strait of Hormuz. Iran has its own blockade on the Strait of Hormuz, allowing some ships through the strait as long as they pay this little toll. They got this little thing going on. Oil is still ripping higher. I mean, there's no denying it. Today, obviously, at the time of this recording on Thursday, USO, I think, was down. I can't remember the exact percentage, but it was down on the day for sure. But if you look at sweet crude futures, Brent futures, they are still within striking distance of year-to-date highs. Like, the oil has not come off even a bit. We're still trading at extremely elevated energy costs, and that is yet to show up in the inflation figures. And this market is just marching higher, completely ignoring the fact that oil has not come off and just accepting that whatever Trump says about, oh, we have a ceasefire, there's a little deal, we keep going back and forth. Vance might go to Pakistan, we might not go to Pakistan. There's peace in the region, we might do boots on the ground. It's just a bunch of malarkey. It's almost like I've heard people say this in the past before. It's like Trump's strategy is to flood the media with so many little data points that it's impossible for anybody to keep up or truly know what the heck is going on. And the facts are the facts. Oil really hasn't come off where it was when the war started. That's going to show up in inflation. That's going to harm the market. Eventually, that might not show up right away in these first quarter earnings. It seems to me that the first quarter, on average, a lot of these companies have been beating and raising or beating and reiterating guidance. I think net, this quarter so far has been a win. We still have a lot of companies to go, and we're only about halfway through the S&P 500. I think over half, actually. But there's still a lot of companies to report. And maybe because the war started so recently, these inflated energy costs haven't shown up in the numbers yet. So we have to wait for quarter two. We don't know. Maybe quarter two is when the sell-off truly happens and you start to see some of these names say, hey, costs have gotten out of control. We are struggling to pass them on to the consumer, and our margins are getting squeezed. Maybe that's what happens in the second quarter. Maybe it's not the story of the first quarter like people were predicting. Only time will tell, but I'm telling you, at some point, this price of oil is going to be a huge factor in the market's inability to break out to new highs, I think. And all this rhetoric about, oh, there's peace in the Middle East right now. It's malarkey. It's malarkey. And if I could swear on this show, I would. I would say it's bleep. Come on. So let's move on to the final topic of the show. We're going to talk about Avis Budget Group, which is that car rental company. When you show up at the airport, you see the big Avis sign and you go in and you get your Toyota Corolla or Highlander or whatever it is, and then you're on your way to your destination. We got to sit here and wonder, why did a $100 stock go to 800 in the matter of days and then implode back to just below 200? It truly makes zero sense, and that's why we're going to discuss it on this show right now. So here was the setup. I don't remember the exact name of the two hedge funds, but two hedge funds, they've accumulated 71% of Avis's actual shares. And there was a little thing that they did with total return swaps where they actually ended up owning synthetically over 100% of the company. Total return swaps are this product where, well, if you know what a swap is, basically you're swapping cash flows. So they would go to a bank and the bank owns stock in Avis, for example, and then these hedge funds would go to that bank and say, hey, can we have a swap product? We'll pay you a premium on the swap, which is, a right to own the swap product or the swap contract with the bank. And then the bank's going to basically pay you back all the returns, dividends, any cash flows from Avis Budget Group. It's basically a synthetic way to own the stock. You're going to pay the bank to own their stock because you're going to realize all the upside in the name by doing so. So that's sort of what that total return swap is. And it's important for understanding what happened here because it allowed these two hedge funds to cumulatively own over 100% of the name. So the idea behind this is you can really load up on a position and own a ton of stock in a company without actually having to disclose in a 13F filing that you own all the shares in that company. So for example, these two hedge funds, if they own 70% cumulatively of just stock, let's just say they own 35 and 35 each. I don't know how many actual shares that is, but they would have to report on their 13F that, hey, we own this much Avis. But in actuality, because of these total return swaps that they purchased from a bank, they owned a lot more than that without having to legally report it. So you have a extremely concentrated shareholder base, essentially two different shareholders. And then you factor in this idea of a short interest. Now, a short interest is how much of the stock's float, which is the tradable shares out in the market, is sold short. How many people have borrowed shares from their institution or bank where they trade and sold them short, betting on the company going down? 54% is the number. And just to put it into perspective, if you're not a trader, if you have a short interest of over 20%, that's considered extreme. So 54%, over half of the float was sold short. That is a recipe for a short squeeze, my friends. If you don't understand shorting, when you short a stock, you eventually have to buy it back. If your goal is to buy it back at a lower price, return the stock to the bank, you earn the difference. That's your P&L. If you have a losing position and you have to buy it back at a higher price, you're basically paying more for the stock than what you sold it for, so you lose the difference. That's your loss. So when you have half the available shares sold short and they need to be bought back, and then you have two institutions that own most of the stock, and then you have this mechanism, I guess, where all of a sudden all these people that are sold short, 54% of the stock is sold short, remember, have to buy back the stock, and there's not enough stock trading in the market because two institutions hold it. You're now reaching, you're grasping to get out of this position, and the higher the stock goes, the more extreme things get, because these people who are sold short are like, shoot, I'm gonna get margin called. I'm gonna blow up in this name because this position is getting out of hand. And so it's the opposite of a fire sale. You're almost fire buying, I guess. You're not just hitting bids. You're taking the offers way above. You're buying stock that maybe the spread is like 20 points and you can't get out. So you're doing anything and everything that you can to buy back that name. And so that's what creates the situation that we saw in Avis, where you had a $100 name ripped to 800 and then come plummeting down back to below 200. Anyway, so at 800 bucks, obviously this money losing budget car rental company trading at $800 a share was some astronomical multiple. I don't remember the exact, I think the multiple I read was 140, 150. It might even been more than that, but that's obviously an insane multiple for a company that's losing money. It makes absolutely zero sense. So I felt like I had to bring it up on the show. Go pull up that chart, go watch that price action. If you haven't heard about it or seen it, go read up on it. I think the idea of these total return swaps is actually quite interesting if you're interested in finance. So go do a little bit more research on that. I just wanted to bring it up on this show because I thought it was the silliest, dumbest thing I've ever seen. And it was truly it was one of those examples in finance where a couple of shady, I don't want to say shady, but suspicious actors can really manipulate the price action of a name like we saw there. And it's just good to be aware of situations like that and understand what happened so that when you see it happen again in some other name, it's inevitable, it's going to happen again. You sort of know what's going on and you know to stay the F away. So anyway, that's all I have for today's show. That was 4 little quick pointers I wanted to talk about. Hopefully it wasn't too word saladly. Thank you so much for listening. I hope you have a fantastic Friday and a great weekend. Make sure to follow us on all of the socials. That's Instagram, YouTube, and TikTok. This week was a little bit of a slow one with me coming back and getting into the speed of things. But yeah, thanks so much for listening. Take care, and I'll catch you on the next one. The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast.